today is HSBC raises its gold price target and also gets bearish.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. It's 8:34. We had a power outage in Stamford, Connecticut, so maybe the whole air conditioning energy issue is starting. So we're getting started a little bit late, and I'm going to go through this a little bit faster than normal. Let's adjust my screen. There's the homepage. There's the markets. Metals are down and rallying. Copper is up and strengthening. Stocks are up a little bit. Bitcoin is stable. Grains are down 30 basis points, and PGMs are negative, but everything is kind of levitating over the last hour or two. Our first story, the thing that we want to focus on today, is HSBC raises its gold price target and also gets bearish. Now, this has been in the news. The mainstream media has been all over this, saying that they have gotten bearish. We're here to tell you there's more to it than that. They've been bearish, and their price targets have been lower than the other major bullion banks like Goldman, like even JP Morgan. So HSBC's been raising their price target. They've been good. They've just been behind it. And so now they've raised their price target again, still below the current price, but they're doubling down saying we are bearish. Don't think because we raised our target, we've become bullish. We go through the whole thing in the report. So I'll just read a little bit here for you. HSBC raised its gold price target, but still kept it below current levels, while simultaneously turning bearish into late 2025. The bank sees waning physical demand, rising mine supply, and ETF normalization as key risks. Jewelry and coin demand are collapsing, they note, though that is to be expected, we note, at high prices. So on the other hand, central bank buying and investment are surprisingly strong. Retail is running out of bullets, we note, but sovereign entities and high-end physical buyers are still buying hand over fist. You're not buying jewelry, you're not buying coins, you're buying 100-ounce bars. You're buying 100-kilogram bars. So we have taken that whole report. Luckily, we've got a copy of it, and we broke it down, including all the charts, and there you have it. A little bit more from that. There's a chart. Despite geopolitical and fiscal tailwinds, HSB says the 3,500 ceiling holds up. So there's tailwinds keeping gold up, but all that's known is known. And so unless there's a real escalation, there's probably not going to be a new high, is their opinion. The revised forecast underscores the behavioral paradox. We note higher targets, yet a lower conviction on sustained upside. Which is a signal, a raised target or the lower outlook, as we ask. Full analysis is in the premium post. HSBC raises gold price target and then gets bearish. A little bit of a cheeky statement there. Also, we just sent out a podcast, Gold Stablecoins in the Next Bubble. And we'd like to, we think it's an important work going forward. But there will be a bubble in gold. And the bubble will be precipitated by stablecoin proliferation. And you don't have to buy stablecoins to participate in the gold bubble. But there's going to be one that's going to come. Stablecoins are a delivery mechanism for an asset that people want but can't get their hands on. You're going to see it. So the first part of this piece describes Wall Street's methodology since 1971. Stablecoins may soon dominate gold ETF markets by merging physical backing with digital convenience. Custodianship remains a trust risk, but the network may begin valuing tokenized gold on par with physical. Going back to the Wall Street thing, Wall Street as an entity survives and excels by seeing the big shift and then creating product to go with it. And it's easy to see the big shift when the government is subsidizing it. So in the 1970s, debt was subsidized when Nixon went off the gold standard, 1971. So by the 1990s, everyone was borrowing. Now people are borrowing for their next McDonald's meal, okay? The subsidy in the pipeline now is stablecoins. It's financialization of real assets. Wall Street sees this. Wall Street lobbies for it. Wall Street creates product for it. And the point of that spear, the bleeding edge of that knife, is gold, because you can't start a stablecoin with something that's volatile. It has to be something that's stable and whose quantity is known. Right? We just sent that out this morning. Data on deck today, 2 p.m. Fed meeting. Charts and final market check. Copper jumped on Trump's, these are my notes. Copper jumped on Trump's tariff threat. Silver bounced, but remained susceptible to new selling in the form of copper-silver spreading, ultimately leading to another 4 to 5% day higher when silver shorts realized that was a bad idea. But you got to wait for that, okay? This market has a proliferation of, here, I'll pull the, here's silver. This market has a proliferation of, here, I'll pull copper up, of hot traders, and they were short copper, and now they're buying it. They're covering the shorts, and now they're selling something else. And they're selling silver again. So while silver is off its lows, it's going to meet resistance. Buy copper, sell silver, buy copper, sell silver. Buy copper, sell gold. Who knows? But there's a bunch of shorts like hide the P moving around out there. And there's enough shorts in silver as it is, but more are going to pile on. And we're going to get a 4 or 5% rally when that happens. Now, copper, that's a new all-time high, right? And I'm not going to predict whether the tariff's going to happen or not. But I will say this. Some people are making the comment that why would we tariff a commodity or a critical mineral that we import? We don't import net raw copper. We export raw copper. We're using it as a tool to project power on the countries we're negotiating with. Now, I'm not pro-Trump how he does these things, but I'm saying this. If you're going to restrict a raw material and you're China, you restrict rare earths. If you're going to restrict a raw material in the US, you restrict copper. The thing about copper is we export raw ore and concentrate, a lot of it. We import rolled copper, processed copper, refined copper. It's ridiculous. So by using copper as a stick, a smaller country that depends on our copper will be more likely to negotiate. By withholding copper, you can now use that higher price to subsidize the refineries that need to be added to and grown. Same thing with steel. Okay, so Trump could have picked a worse metal to do that with. That's not a bad metal to do it with. And will it create tailwinds for silver? Yes, but not right now. Everybody's worried about their copper position. So that's how it works. Okay, I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.